And Kenya's government has finally detailed the firms that it would like to privatize in its privatization program, even though it doesn't include its biggest loss-making entity, Kenya Railways. Now, between them, the 11 firms have a gross asset base of about $1.27 billion, 73% of which is in one company, Kenya Pipeline. That firm is a fuel logistics monopoly with control of the country's fuel pipeline network, which covers over 1,300 kilometers. Of those 11 firms, 5 are profitable. Others, such as National Oil, have an uncertain future as a going concern. Now, the company's losses doubled in the fiscal year ending in June 2021, and the size of its liabilities are triple those of its assets. 4 weeks ago, at the annual meetings of the IMF and the World Bank, Kenya's finance minister described the country's new privatization law as a critical tool in cutting the country's fiscal deficit.
But the most important thing is the positivity about it is that it gives us diverse solutions of privatization. That's one thing. The second and the bigger picture, which is the elephant in the room here, is actually the line that we had taken about reducing the fiscal gap. Yeah. This is a mighty one. And so I am smiling by the prospects of even having different models or solutions or even diverse solutions of privatization. But I'm smiling because they are going to reduce the fiscal burden. It's very, very important. And the world has changed. It's not where we were when this privatization bill was enacted in 2009. Things have changed. We haven't privatized any company since then. But here we are with a new tool that reflects the current times and the future times. So we have diverse solutions. You can imagine the smile I have when I see that all this road of SOEs, state-owned enterprises, will stop, will stop, and the fiscal burden of transfers will actually stop. So you're not going to look at only the ones that are making profits. You are looking at others, because of their strategic nature, are going to be very important. That's why when I say about diverse solutions, it means that you're not going to leave anyone behind. Privatization doesn't mean you kill the ones that were making losses. It means they were making losses just because of their strategic nature.
Well, let's delve further into the sale of those state firms. Some hours ago, CGTN Ramanyang spoke to EFG Hermes Managing Director for Frontier Equity Sales, Muafi Kilonzo. And he started their conversation by asking Kilonzo why Kenya Pipeline is such an attractive firm for an initial listing at the Nairobi Securities Exchange.
The reason I say pipeline is interesting is because as a stock market player, this is the type of business that would have the scale to really become a catalyst for the market. Because you see, what really is needed, and we saw this in the Middle East, where the state governments started to list their companies. So there was Dubai Taxi, which is ongoing, for example. There was Dewa in Dubai. The Qataris have also listed their pipeline business. So I think these are types of assets that have the scale and the reach to attract a wide range of market participants. And I think that's what we need.
And Kenya Pipeline is in an interesting position because they've got 1,300 kilometers of pipeline. There really isn't a competitor, for lack of a better word, in that space. It's virtually a monopoly in that sense, in the sort of the specific market niche that they occupy. So it's, you know, profitable, relatively profitably consistent, doesn't have much debt, it's got relatively reliable revenues. It's a sort of business that, you know, would just be essentially throwing off cash over the medium term.
Exactly, and these are the assets that people like because it has a predictable cash flow. It's very easy to model. It's just what the throughput, what product is going through. It's a monopoly. It's got very high replacement costs. So there's no threat of competitors emerging very quickly or easily. So I think that certainly was a very interesting asset that was on the list. But having said that, I think what also struck me about that list is that there was something for everyone. You know, there were entities on there that looked more suited to trade buyers, i.e. people in that industry. There were some assets on that list that are particularly intriguing, that have a nice consumer story, such as New KCC, for example. And, you know, Kenya Seed is also a very interesting business.
Indeed, it would be interesting to see if a big player like Danone, for example, might be able to take it up. But I want to get back to the remainder of the list, right? Because there are all these interesting companies that are making money, that are consistently profitable. The new KCCs, the Kenya Seeds, the Kenya Pipelines of this world. But if you look at the remainder of that list, there are quite a few companies there that are loss-making. Numerical Machining Corporation, for example, or are deep in negative equity territory, like National Oil. So in order to essentially package these firms and put them on the market, we're essentially going back to the playbook, I suspect, that we had in 1993, 1994, right? Where we essentially take the liabilities onto the public balance sheet and then sell off the quote-unquote good parts, the assets of these businesses, onto the private sector. Or is there a different way of structuring this sort of deal?
I mean, that's a really interesting point. I think that may be one way of doing it. But sometimes actually you realize that perhaps to reverse the losses may not be so difficult. It may just be a question of operationally tweaking a few things. And, in some of these companies like Numerical Machining, when you look at them, they actually are fascinating, because this is a true sort of manufacturing, very niche type of player. There probably aren't many others in there who do that sort of, make those sort of products, fabrications, the CNC work, etc. So it may actually be something that an industrial player may find very interesting.
The playbook I'm referring to is essentially what happened in 1993, 94, essentially with KQ, right? So back then, the idea was, we'll take some of the bad debts that, that have saddled this airline for a very long period of time, take those, put them onto the public balance sheet. But looking at the scale of what needs to happen here, is there even enough space in the public balance sheets to accommodate all this extra debt?
Well, that is a very good question, and to which it really is a question of the liabilities. I think what we've been seeing published are asset sizes, but we don't have a full idea of what really the audited liabilities are. And in some instances, the data that we're getting is a little bit dated. So we don't actually have current information on the position of these companies. And I think also the other thing to bear in mind is some of the assets may still be valued at book value back in, going back decades. So there might be land assets, there might be property that actually is quite interesting. So the question probably for any buyer is buying into some of these assets where you need to do a radical restructuring. Is there the political will to allow for example, staff reduction, for example? Is that really the type of story that the government wants? So it's going to be a delicate time just because of the delicate macroeconomic environment. And because the government's balance sheet is also stretched, there probably will be a limit to how much leeway they can give to people. It may just have to be, here is the asset, what do you think it's worth? Because talking about its assets without knowing its liabilities, we don't actually know what these businesses are worth.